The year was 1923. The United States was buzzing with the energy of the Roaring Twenties. It was a time of unprecedented economic growth, cultural flourishing, and technological advancements. The stock market was at the heart of this vibrant era, reflecting the optimism and dynamism of the times. Amidst this backdrop of innovation and growth, a new player emerged in the world of finance, the Standard Statistics Company. Founded with the vision to provide comprehensive financial data, it aimed to bring more transparency and insight into the burgeoning market. This company, later to become Standard & Poor's, introduced a composite index tracking the performance of 90 prominent American companies. This index was revolutionary, offering investors a new way to gauge the market's overall performance and make more informed decisions. This marked the humble beginnings of what we know today as the S&P 500. Over the years, the index evolved, adapting to the changing landscape of the American economy and expanding its coverage to include a broader range of industries. Initially, this index covered only a fraction of the market, focusing on industrial companies. These were the giants of the era, driving the nation's economic engine with their innovations and production capabilities. However, it quickly gained traction as a reliable gauge of the overall market's health. Investors and analysts alike began to rely on the index for its comprehensive snapshot of the market's performance. In 1957, the index expanded to encompass 500 companies, solidifying its role as the benchmark for American equities. This expansion was a significant milestone, reflecting the growing complexity and diversity of the American economy. The S&P 500 wasn't just a list of companies, it was a reflection of the American dream, a barometer of economic progress. It symbolized the aspirations and achievements of countless individuals and businesses, capturing the essence of a nation on the move. Today, it remains a vital tool for investors worldwide, embodying the spirit of innovation and resilience that defines the American economy. The S&P 500's journey has been anything but smooth sailing. It has weathered numerous storms, each leaving its mark on the index's trajectory. From the Great Depression to the tech bubble of the late 1990s, the S&P 500 has witnessed it all. These periods of volatility, while unnerving, have ultimately reinforced the index's resilience. Each crisis brought with it unique challenges, testing the mettle of the American economy. Yet, time and again, the S&P 500 emerged from the ashes, stronger and more resilient. This enduring strength is a testament to the power of innovation, adaptation, and the unwavering spirit of American capitalism. The Great Depression of the 1930s was a period of unprecedented economic turmoil. It was a time when the world faced severe financial instability, and millions of people lost their jobs, homes, and savings. The impact was felt across every sector of society, from the bustling cities to the quiet rural areas. The stock market crash of 1929 sent shockwaves across the globe, plunging the world into a deep recession. Banks failed, businesses closed, and the unemployment rate soared to unprecedented levels. The crash was not just a financial disaster, but a human one, affecting the lives of countless families. The S&P 500, still in its infancy, plummeted alongside the market, losing over 80% of its value. Investors watched in horror as their life savings evaporated almost overnight. The financial system seemed to be on the brink of collapse, and confidence in the market was shattered. This period tested the very foundations of the American economy. It was a time of great hardship and uncertainty, but also a time of resilience and determination. People had to find new ways to survive and adapt to the changing economic landscape. However, it also underscored the importance of long-term investing. Despite the immediate losses, those who maintained a long-term perspective and did not panic were able to weather the storm. The principles of patience and perseverance became more evident than ever. Those who held on to their investments despite the fear and uncertainty were rewarded in the long run. The market's eventual recovery proved that staying the course could lead to financial stability and growth. It was a lesson in the power of resilience and the importance of not giving in to short-term fears. The S&P 500 eventually recovered all its losses, demonstrating the market's ability to rebound from even the most severe downturns. This recovery was a testament to the enduring strength of the financial markets and the potential for growth, even after significant setbacks. It highlighted the cyclical nature of the economy and the importance of maintaining faith in the long-term potential of investments. Following the turmoil of World War II, the United States entered a period of unprecedented economic expansion. The S&P 500 rode this wave of prosperity, experiencing steady growth throughout the 1950s and 60s. This era saw the rise of consumerism fueled by technological advancements and a booming middle class. The late 1990s brought about another period of rapid growth, driven by the dot-com boom. The rise of the internet and the proliferation of personal computers fueled a surge in technology stocks, propelling the S&P 500 to new heights. This period showcased the index's ability to adapt and reflect the changing landscape of the American economy. Section 5. Navigating the dot-com bubble. The dot-com bubble of the late 1990s was a period of irrational exuberance in the stock market. Investors, captivated by the transformative potential of the internet, poured money into technology companies, driving valuations to unsustainable levels. This speculative frenzy, however, proved unsustainable. The bubble eventually burst in the early 2000s, leading to a sharp correction in the stock market. The S&P 500, heavily weighted towards technology stocks, experienced a significant decline. However, this correction served as a reminder of the importance of sound investment principles, such as diversification and value investing. Section 6. The 2008 Financial Crisis, a test of resilience. The 2008 financial crisis was the most severe economic downturn since the Great Depression. Triggered by a collapse in the subprime mortgage market, the crisis quickly spread throughout the global financial system, leading to a credit crunch and a sharp decline in economic activity. The S&P 500, reflecting the broader market panic, plummeted over 50% from its peak in 2007. This crisis tested the resilience of the American economy and the global financial system. However, it also highlighted the importance of government intervention and the need for stronger financial regulations. Section 7. Steady growth and the power of compounding. Despite these periods of volatility, the S&P 500 has demonstrated remarkable resilience over the long term. Since its inception, the index has generated an average annual return of around 10%, accounting for inflation. This consistent growth underscores the power of compounding, where even small gains can accumulate significantly over time. This long-term growth is a testament to the underlying strength of the American economy and its ability to innovate and adapt. The S&P 500's track record demonstrates that over time, the stock market tends to rise, rewarding patient investors who stay the course. Section 8. The S&P 500, a haven for all investors. The S&P 500 is not just for seasoned investors. It's an accessible and beneficial asset for individuals from all walks of life. Whether you're a young professional just starting out or a retiree seeking to preserve your nest egg, the S&P 500 offers a straightforward way to participate in the growth of the American economy. Investing in the S&P 500 can be as simple as purchasing a low-cost index fund or ETF. These investment vehicles track the performance of the S&P 500, providing investors with broad market exposure without the need to pick individual stocks. Section 9. Diversification and long-term growth, a winning combination. One of the key advantages of investing in the S&P 500 is its inherent diversification. This index comprises 500 of the largest companies across various sectors, providing a broad exposure to the market. By investing in a basket of 500 companies across various sectors, investors can mitigate the risks associated with putting all their eggs in one basket. This means that if one sector underperforms, the impact on the overall portfolio is cushioned by the performance of other sectors. This diversification helps to smooth out returns and reduce volatility over the long term. Instead of experiencing the sharp ups and downs that can come with investing in individual stocks, The S&P 500 offers a more stable growth trajectory. Combined with a long-term investment horizon, this diversification makes the S&P 500 a compelling option for investors seeking to build wealth steadily over time. The power of compounding returns over many years can significantly enhance the value of an investment. While past performance is not indicative of future results, the S&P 500's track record suggests that it is likely to continue generating positive returns over the long haul. Historically, the index has shown resilience and growth, even in the face of economic downturns and market volatility. Investors who remain patient and committed to their long-term goals often find that the S&P 500 provides a reliable foundation for their investment strategy. By staying the course and avoiding the temptation to react to short-term market fluctuations, they can harness the full potential of this diversified index. In conclusion, the combination of diversification and a long-term investment approach makes the S&P 500 an attractive choice for those looking to build and preserve wealth. With a well-thought-out strategy and a focus on the long term, investors can navigate the complexities of the market and achieve their financial objectives. Section 10. Empowering your financial future. Understanding the stock market and the power of long-term investing is crucial for achieving financial security. It's never too early or too late to start investing in your future. Empowering yourself with financial knowledge is the first step towards taking control of your finances and building a brighter future. Section 11. The journey to financial literacy. Embark on the journey of financial literacy today. There are countless resources available to help you get started, from books and articles to online courses and financial advisors. Take the time to educate yourself about the stock market, learn about different investment strategies, and discover the power of compound growth. Remember, the greatest investment you can make is in yourself. By investing in your financial education, you gain the knowledge and confidence to navigate the world of finance and secure your financial well-being. Please like and subscribe. Check the comment section for resources to further help you in your financial education.